Whenever there is an all too frequent outbreak of violence in the Middle East, commodities traders' thoughts quite naturally turn to what may or may not happen with the price of crude oil. What I want to do is to have a look at what is happening at present with crude, but also to look at the notion of how people build narratives around commodities and what their impact might be. It is quite possible to generate a chart looking back at crude prices going back several decades. Some of these charts even go back purportedly 150 years. I have a difficulty with these sorts of charts, as people know, because you're often appending different data sources to one another, and you are trying to compare periods in history where there might have been a fundamental change, where the world has changed so dramatically that the prices you are seeing reflected from that period don't hold the same relevance as they do now. The thing to note about crude oil is that futures trading of crude only began in 1983, so it is a relatively recent event. However, because crude is traded on a regulated exchange, it has tremendous price discovery and great regulation. Therefore, we can trust the notion of the fidelity of what is happening with crude itself. This is Brent crude, tracked quarterly going back to the beginning of the trading of the futures contract. What I did was I looked at several what you would call reasonably significant geopolitical events, and I've mapped them over the top of this particular chart. One of the things we have to be careful of is this notion of assigning a causality to something where there might not actually be a true cause. There is an argument to be made, and I do have some sympathy for the argument, that markets go in the direction they do because they do. It seems somewhat circular in its logic. But once you understand that markets are made up of people who are fundamentally illogical, then it does begin to make more sense. Added to that, you need to understand that markets are their own ecology. They are their own environment. So once they get going in a given direction, they can be self-perpetuating. Quite naturally, there are events such as when Iraq invaded Kuwait that caused a spike in the price of crude, and I will look at that in a moment. But we have to be careful about these post-dictive responses of looking backwards and saying that occurred because of this. We are never certain that that is the true causative element. This means that whenever you're building a narrative around an event, you have to be aware that you're building your narrative in real time. That real-time narrative might not apply when you look back at historical events. Also within your narrative, you have to build in the understanding that markets are future pricing instruments. In commodities markets, yes, you can get shocks, and you can get a shock in a market like crude. But the majority of the time, markets are very good at information collection. They're very good at surveillance. And so price is a reflection of that surveillance. Any event you think is having an impact now may have been priced into the market 12, 15, 18 months ago. This needs to form a cornerstone of your narrative. If we look at what was a true shock to the crude market, if we look at first Gulf War, Iraq's invasion of Kuwait, you'll see I've put a little marker here. That marker indicates the point at which tensions began to rise between Iraq and Kuwait. Subsequent to that, you can see price explode. What I've done is I've taken the weekly changes of prices and I've put them in this little table, the top left-hand side. You can see they are quite significant changes. We're talking about in the first week, a gain of 6.2%, 2.3, 2.7, 3.3, slippage backwards of 4.3, then a series of another significant gains. What is interesting is the gain stopped in October, but the war did not officially end until January. This is this notion of markets being future pricing instruments. By October, it was clear that the Western coalition was going to win. So markets priced that in. They thought about that, considered the implications, and then moved on. This brings me to the center point of this video, and it is this notion of, if you are building a story, if you're trying to convince yourself of something, what is the nuance within your story? As an example, one of the problems with many of the commentaries that I've come across recently, speaking about the Middle East, is it assumes that it is a monolith. It is monochromatic in that all Arab states are the same. That's not true. This is a mistake that was made in the 1990s, talking about Yugoslavia. It's a mistake that was made talking about the Soviet Union. The various Arab countries are distinctly different. They're different ethnically, religiously, economically. That needs to be taken into account if you are building some form of narrative. We generally have this very simplistic linear argument that goes, outbreak of violence, this will affect the price of oil, therefore price of oil will go up. It doesn't understand the distinct nature of the Middle East. Not all countries are the same. For example, the Gulf states of Iraq, Kuwait, Bahrain, the UAE, Oman, are very different from the failed nation states of Egypt and Syria. Iran is quarantined because of decades-long sanctions. So you have this very diverse little ecology going on that is not all the same. Yes, things may shift, things may change, but at present, any narrative that simply says there is an awful conflict going on in Israel, Gaza and Lebanon, therefore the price of oil will go up, is very simplistic and is not reflective of the whole. It's not understanding how the world works. This is reflected when you look at longer-term charts of crude. What we see here in this chart of crude, let's say from the end of 2023, is price drifting in this wedge formation. Last week, positive. There was actually a positive move, but by and large, it's a range-bounded price. This is a trader's market. If you can time correctly these swings of price, but it is not the same as, say, 2022, 2021, where price was quite clean and clear in moving upwards. If I look at this but with a long-term filter applied, if you've seen any of my other videos, you will know that I have a tendency to do this. It's an attempt to remove noise. One of the issues with looking simply at price is that price can be noisy, and noise is distracting to traders. We tend to be attracted to it. You're better off putting in some sort of filter and then stepping back and saying, what does the filter say? Does the filter say go, don't go? And make your judgment from there. The use of filter should be part of everybody's trading decision, if only, as I say, to remove you from the noise. So when we look at it weekly, we see that for the past year, price has been flip-flopping between indecisive, bearish, bullish, backwards and forwards. This is reflective of this drift. At present, the filter has flipped to be bullish, but it's not the world's most convincing signal. The notion that it is not a convincing signal can be seen when we slip down a time frame. I consider crude to be a trader's market, therefore you trade it on daily time frames and lower. What I've done here is simply apply my breakout system to it. Breakout systems, unfortunately, can be influenced by slop, and this is a sloppy market. So if you look at the last signal from Friday, yes, it has generated a buy signal, but it is incredibly weak. And by weak, I mean if you have a look at the candle, there's a lot of rejection in there. There's not a lot of price confirmation, so I would pass on this. I would wait for a much, much better signal. Remember, patience is free, and the first thing all trading systems should force you to do is wait. I understand that markets generate this intensity that causes you to want to take action. There will always be another trade. There will always be another entry signal. The issue we also have, if we're generating a narrative, so let's explore the notion of a narrative a little bit further. The narrative says, conflict in the Middle East, price of oil goes up. That should be reflected. It should be reflected in the price of crude itself in all its iterations. But it should also be reflected by sophisticated investors who move into analogues. Portfolio traders who do things like managed superannuation would by and large not move into the futures market. They would look for analogues. And by an analogue, I mean a given stock that has an exposure to this market that would benefit from a lift in the oil price. To explore this, I had a look at the weekly change for top 15 ASX energy stocks as ranked by market cap. These are the changes I came up with. They're all really quite modest. There's nothing that stands out. Yes, Strike does stand out there, but Strike is a 23-cent stock. It's not really a heavyweight. If we were to move to a different market to see whether it's reflected universally, I repeated the same exercise looking at US stocks, and these are the top 15 as well. You have the same muted response. My expectation was that if investors were truly concerned about violence in the Middle East spreading and getting out of control and impacting the price of oil, then you would see it occur as ripples in these stocks. You would see these stocks start to move. But at present, and I do say at present, that is the qualification, they are not moving. That to some degree puts a full stop at the end of the initial narrative. And something has to be added to the narrative, or something else has to occur to expand upon the narrative. At present, that's not occurring. I do understand, and I have received material that says something along the lines of, as a financial planner, I advise you to buy an ETF with exposure to oil. My advice would be don't. It's a stupid idea. To give you an indication, this is BetaShares Crude Oil Index ETF, mapped against the price of crude. I get the same picture irrespective of the ETF I match against the price of crude. As a general rule, ETFs that gain their exposure by buying the current futures month underperform the actual commodity when the commodity is trending up. This is due to a function known as contango. You're constantly chasing price. If you're going to try and gain exposure to crude, don't use an ETF, unless you can find one that has exposure to oil shares. The easiest way for people to gain exposure to crude is to actually buy crude. It is also to look for analogues in one of the stocks we've just looked at that is actually moving. This brings me to this notion of what would cause me to take action on a daily time frame. It would be a much better signal than this. It would be a much stronger signal than this. Because this is quite weak. We can see we're still bounded. Price is still bounded. It is not broken up. We've had one or two good periods, but we need substantially more than that, and we need one or two good weekly periods within which we can operate and in some way, shape or form shift the edge in our favour. Given that I am a fan of the history of markets and how markets function and how instruments come to be the way they are, as a final point, I would recommend for people who are interested in adding to their reading list that they get hold of this book. This is very good. It's The Prize by Daniel Yergin. It looks at the role of oil, particularly in the 20th century, and how it has formed the world we live in. More importantly, it talks about the impact it has on society and why it occupies such a pivotal place, even outside of its economic importance. It also looks at why the Middle East is shaped as it is. So we come back to this notion that you actually need to understand within the very broadest of timeframes where you sit and what the context of the time frame is. And then you begin to narrow that context down by narrowing the time frame down. And this begins to give you an idea of where you sit within the boundaries of price and what price must do to prompt you into some form of action. This then becomes an issue such as we saw with the Gulf War, where you get a series of very clean signals that last for a very short period of time and then end. So we roll back to this notion that markets are very good at collecting information and pricing themselves accordingly. with that in mind, any story that you generate, any rationale you generate for trading oil must really be based around this notion of what is the nuance? What are the points of difference? What is the variant perceptions that other people might have? Because the important thing to notice in trading is that your opinion is not the only one. Other people have other opinions. You need to be aware of those, and you need to take those into consideration when you put money on your opinion,